Good morning. I'm Peter Milios from the Finance News Network. The Dow Jones Industrial Average dropped on Monday as a plan to backstop all the depositors in the failed Silicon Valley Bank, along with other extraordinary measures, failed to boost bank shares. The losses were contained as some investors bet the financial shock could cause the Federal Reserve to pause interest rate hikes. Traders are pricing in at about a 2-to-1 odds that the Fed raises its benchmark borrowing rate by a 0.25 percentage point at the meeting in late March. Goldman Sachs has gone even further, saying it no longer expects the Federal Reserve to hike rates at its meeting next week. The Dow Jones Industrial Average lost 0.28%. The 30 stock index, which posted its fifth straight day of declines with Monday's session, was able to pare losses after dropping more than 284 points earlier in the session. The S&P 500 ended down 0.15%, falling as much as 1.37% at one point. The Nasdaq Composite closed 0.45% higher. But investors bought up other areas of the market outside of banks, such as some technology stocks like Apple and defensive names including Johnson & Johnson and Eli Lilly. Shares of US regional banks slumped on Monday, led by sharp losses in First Republic Bank, as news of fresh financing failed to assuage fears of possible bank contagion following the collapse of SVB Financial Group and Signature Bank. Federal regulators hope that the sweeping backstop they introduced yesterday to insulate the US financial system from Silicon Valley Bank's collapse will hold, even as the regional lender Signature Bank. But yet another institution, First Republic, appears under pressure today, despite securing funding, and the blame game is well and truly underway. The First Republic reflects investor fears about banks' health. The independent lender said yesterday that it had secured access to about $70 billion in additional liquidity from the Fed and JP Morgan Chase. But its shares were down nearly 60% in pre-market trading, suggesting markets are worried that it remains in trouble. However, one emerging ramification that still warrants attention is the impact on mortgage-backed bond markets and the aftershocks that it could cause elsewhere. SVB is still sitting on a $50 billion book of mortgage-backed securities. It might need to dump those bonds to help give depositors some of their money back if it isn't sold, or possibly even if it is. And overnight, there have been two big M&A transactions in the biotech sector. Firstly, Sanofi SA has agreed to purchase US-based pharmaceutical firm Prevention Bio in a deal worth approximately $2.9 billion as the French drug maker looks to boost its general medicines portfolio with a US-approved type 1 diabetes drug. The takeover price was a whopping roughly 273% premium to Friday's closing price. And in an even bigger deal, Pfizer announced on Monday that it has struck a $43 billion deal to acquire Siegen and its targeted cancer therapies as it braces for a steep fall in COVID-19 sales and a generic competition from some top-selling drugs. The takeover marks Pfizer's largest purchase in a string of recent acquisitions, utilizing a once-in-a-lifetime cash windfall from its COVID-19 vaccine and treatment. It will add 4 approved cancer therapies with a combined sales of nearly $2 billion in 2022. Overall, overnight, the S&P 500 sectors were mixed. Real estate was the best performer, whilst financials was unsurprisingly the worst performer by far. The SPY futures are pointing to a 1.9% fall. Thank you for listening.